I am Khushbu Jha. I am the founder and CEO of Buy Properly. We're a platform for fractional investing in real estate. And we have with us Anil Sharma, who is our accounting and tax guru. Anil is the president of A4 Tax and Accounting Professional Corporation. He has over 20 years of experience in tax planning, tax preparation, accounting services, and is very, very well regarded in the industry. He is a chartered professional accountant, so he is a CPA, CGA, and he does provide tax planning, tax prep, accounting services to both individuals and businesses in and around GTA. He's our core advisor. We've learned a lot from him every session, and we leverage his knowledge to ensure that we are bringing the most optimal tax structures and tax strategies for our customers' benefits. So thank you, Anil, for joining us today.
Thank you, Khushbu. Thank you so much for a great introduction. And as always, very generous with your appreciation and praises for me. Thank you for that. And welcome everybody to the session who have joined. And I'm hoping that we all will learn things from today's session, which will help you in your taxes. Feel free to ask your questions as we go along or at the end of the session, or Khushbu will also chip in from her side, her experiences and her thoughts on various topics. So let's get into it. As Khushbu said, my name is Anil Sharma. I'm a CPA CGA and my practice is in Toronto. This presentation is specifically for medical professionals like dentists. So I have tried to put the relevant concepts which are used by various dentists in their accounting and tax situation, and I'm hoping it will help you all.
Yes.
In today's presentation, we will cover business structure, benefits of the incorporation, importance of tracking all the expenses, conferences, possibilities of income splitting, advantage of having a holding company, investment company for the excess cash flow from the practice corporation. And then there is a new concept we started a few years back, which is grinding down of small business deduction. We'll talk about that. And then there are some tax planning ideas about the passive income generated by Holdco or the investment company. And also we'll talk about individual pension plans. Then we can take questions either during the presentation or at the end, whenever you feel like asking those questions. So mostly there are three types of structure which most professionals use. One is sole proprietorship, whereas you are practicing in your own name. You don't have any formal corporation setup or partnership structure in place. So in that case, whatever income is earned minus expenses becomes your taxable income, and taxes are paid on a graduated rate basis on that income. Partnership, where two professionals come together, and they could be in their individual capacity or maybe through their own corporation and enter into a partnership and operate the practice as such. In that scenario, again, net income after expenses is allocated to the each partners, and the partners deal with their own taxes. Partnership in Canada is not a taxable entity. So anything partnership earns has to be allocated to the partners, and they report those income on their own taxes and deal with whatever taxes are payable. Third one is incorporation. By and large, most popular, and most people do that because of some tax benefit that corporation have. So income minus expenses, whatever the net income, corporation pay tax on it. Obviously, the shareholder can withdraw salary or dividend from it, and they have to pay tax on their own personal income taken from the business. Now, incorporation tax benefit, one of the most beneficial trait of a corporation is that it pays tax at a very low rate of 12.2% in Ontario on profits up to 500,000. Income exceeding 500,000 is taxed at 26.5%, which is still way below the personal tax rate. In Ontario, if you look at it, the highest marginal rate of tax in Ontario is 53.5%. So 26.5% still feels a very decent rate as compared to that. From the corporation, there's a flexibility of paying the shareholder either dividend or salary, depending on the preferences or the goals the shareholder has for its long-term investment or financial planning. They can take either dividend or salary. We'll talk a little bit about the differences between those two, maybe on a later slide. And
You're
also,
not sharing slides though. Sorry to interrupt you.
Can you see this incorporation tax benefit slide?
No, we don't see any slides.
Oh, that's okay. Sorry about that. I don't know what happened there. Sorry about that. Let's see if this works now.
Yes.
Can you see it now?
Yeah.
Okay. Sorry about that. You can see that now? Hello? Khushbu?
Yes.
Okay, sorry. I thought I lost you. Can you see that now?
I can see it, yes.
Okay, perfect. So this is a slide we were talking about. So we were on fourth point that where in corporate structure, the shareholder has the flexibility of how much salary they want to take to optimize their tax situation between personal taxes and the corporation taxes. There is a possibility of income splitting as well amongst the family members if they are involved in the business. A reasonable salary or dividend can be paid to them if they are actively involved. There are certain rules around it. In order to pay the dividend to other family members, the family member should have active working relationship with the corporation. They must work at the corporation for a certain number of hours for a certain period. Otherwise, dividend will be an issue. However, salary can be paid for whatever hours are worked by that person, regardless of dividend, if it can be paid or not. Now, another thing is because you pay lower tax rate on the corporation, it provides an opportunity to defer the taxes, because if shareholder withdraw all the money from the corporation, they have to pay tax at the higher rate. But if you keep the money in the corporation, you can invest within the corporation or through a holding company and defer the taxes on that money till you withdraw it personally.
When you withdraw, Anil, at the end of the day, you would end up paying taxes then. So would it lead to double taxation in that manner?
No, it will not be double taxation. So Canadian tax system has been designed in such a way that it's not double tax. There's an integration between the personal taxes and your own corporation. Any taxes that have been paid by the corporation are taken into consideration when you withdraw dividend from those retained earnings from the corporation, because dividends are taxed at a lower rate as compared to the salary.
But when I draw a salary, or when I say distribute the overall profits of the corporation, then would that add a second layer of tax? Because I already paid one round of taxes.
Yeah, so if you take salary, Khushbu, if you take salary, then it becomes an expense to the corporation, right? So it will be deducted from that year's taxable income of the corporation, right?
Fair enough.
Yeah, in case of dividend, yes, because dividend is not a tax deductible expense to the corporation, right? So what
Right.
happens? You take the dividend, but the dividends are taxed at a lower rate to take the corporation tax already paid into consideration.
Okay.
So it integrates well. It's not that you are paying double tax on the same money,
Mm.
right? Any other questions so far?
No.
Okay. So now for any business, it's very important that we track all the expenses to optimize the tax situation. If you miss an expense, that it means we are unnecessarily paying taxes on the income which we don't have, as we have already spent the money on the expenses. If we miss the expenses, then we are actually paying excess taxes. Most common expenses in dental practice are professional dues and subscription, medical malpractice insurance, business insurance, rent and utilities, equipment, office supplies, medical supplies, professional fee, staff wages. It's very, very important that we keep a detailed record and a receipt to support all the deductions. When CRA comes looking for it, they want to have everything. They just want to check all your receipts and bank statements, where the money went and where the money come from. So it's always very good idea to keep detailed records and all the supporting documents for whatever deductions you claim. One of very common expense which most medical professionals have is about the conferences for their professional development. If they go and attend those are deductible expenses, and conditions are that they should be reasonable uh, in terms of how much you can spend, and they should be in context of your medical practice, basically. Eligible expense, they could be your registration fee, any transportation, accommodation, meals, and if there are any other reasonable expenses which are directly attributable to the conference. Of course, for meals and accommodation, there are some restrictions. And accommodation, if it's in the same city where you live, then accommodation will be questionable. But if it is out of town, then accommodation is fine. Meals are normally 50% that is deductible, and they should be in relation to the conference itself. If any conference have any personal element to it, sightseeing or taking your spouse along with you for any social networking, which are not directly related to the continuing medical education, then those are questionable and they will be denied by CRA. So need to be careful about those, what can be deducted and what cannot be. Supporting documents, of course, as I said earlier, have to be capped. And whenever CRA wants to review it, they would like to review those documents, not only the receipt, but also the proof of payment, how they were paid from your credit card or from your bank, or even personally if you have paid them. So you need to provide the proof of payment as well as the receipts. Income splitting, yes, if you have family members who are in lower tax brackets, and if they are involved in the business, they are helping you, providing services to the business, yes, you can pay them services for those hours worked. Requirement is that they have to be reasonable, as if you were to hire somebody third party who is unrelated. Whatever you would pay to that person for the services rendered by the family member, the salary paid to family members should commensurate with that. Dividend can be paid if the family member have been working at least 20 hours a week in your business, then you can actually pay them dividend as well. It's always good idea and to keep the record of their involvement in the business. It could be timesheet, it could be a job profile of what duties they do perform, and also the proof of payment of salary or dividend to them. Always good idea to have regular payrolls. If they are working regularly, then bi-weekly like any other employee. I mean, any salary or salary paid as a lump sum would need further explanation why it was paid lump sum rather than on a periodic basis. So it's a good idea that we pay them like any other employee on a regular interval so that questions are not raised. Most medical practices, dentist practices, they will have access cash flow within the corporation. And for liability standpoint, it may not be a good idea to keep all the cash in the medical practice itself. Most people will actually pay the cash out to a holding company owned by them and do all the investment through that. So, and this is done mostly for the asset protection, and sometimes the regulator will also restrict you from having a lot of investment in the medical professional corporation itself. So that is another reason why people would incorporate a holding company and hold their investment in that rather than the medical professional corporation. Having a holdco does separate, business asset investment from your personal asset. It does provide that shield against any liability on your personal asset. So it's a good idea to have a holdco or investment company. Some people ask, okay, what is a holdco investment? They are essentially the same. I mean, it's a corporation. Corporation is a separate legal entity, and because mostly it hold investments or do the investment activity, some people call it holding company, some people call it investment company, but essentially it's a corporation incorporated under any provincial or federal law which you use for your investments. Any question from anybody?
No.
So either I'm explaining it so well, or I'm not making no sense to anybody. No. Sorry about that. Okay, so on to the next one. Recently, the federal government has introduced a concept that if your corporation earns passive investment income, it will impact your small business deduction. As I mentioned earlier, that up to $500,000 of net profit in a small business corporation is taxed at a very favorable rate of 12.2%. But if your investment income exceeds 50,000, it starts grinding down that small business deduction. And every $5 reduction will occur for $1 of investment income, which is exceeding $50,000 threshold. That means if you have $150,000 of investment income, your small business deduction will become zero. So you will not have access to that preferred rate of 12.2%. You will pay taxes at a little higher rate. In Ontario, good thing is it's only the federal tax which is increased, not the Ontario tax. So that passive income does not impact the Ontario tax side of it. So in other provinces, mostly, if you don't have access to small business deduction, your tax rate will be 26.5%. But in Ontario, it will be about 18.2%, even without the small business deduction. Now, what is investment income? Investment income could be your dividends, your interest income, rental income, royalty income, capital gains. In case of capital gains, it's only half of capital gain which is taxable, so only half of that is included in that investment income. There is an exception in that for capital gains. If capital gain is arising from sale of qualified small business corporation shares or qualified farm fishing property, those are generally excluded from the investment income, and they will not grind down the small business deduction. The passive income is considered not only from your own medical practice corporation, it will be combined for all the corporation those are associated with you. So this 50,000 threshold is a combined limit for all the corporations that are controlled by you. To soften the impact of this small business deduction grinding, you could take some proactive steps and reduce that impact. A few ideas are you could invest into the investment which are geared towards capital appreciation rather than regular income. Consider a buy and hold strategy to defer the capital gains. And remember, capital gains is only half of them are taxable, not all of it. So that's another advantage when you are investing into the growth-oriented properties or growth-oriented other investment instruments. You could withdraw higher amounts from the corporation to maximize your RRSP and TFSA contribution. That will leave smaller amount in the corporation, so smaller amount to invest, and obviously that will reduce the investment income as well. Always try and take advantage of tax-free withdrawals. Example of the tax-free withdrawal are, half of the capital gains are taxable. The other half can be withdrawn from the corporation without taxes. So try to take capital dividends from that. That will again reduce the pot which is available for investment in the corporation. Also, you could look at starting your individual pension plan or a corporation-owned insurance policy. That could reduce the cash in the corporation and reduce the corporate investment income as well.
Yeah, and one of the examples of the capital and capital gains tax centered investment is some of the investments on our website, for example, are investments alongside developers' equity, in which case it's a buy and hold strategy. And a large part of those gains are actually capital gains because most of the income comes from growth of the equity, and those are very favorable from tax perspective, especially if you are trying to move your taxes towards capital gains rather than it being an income centric.
Yeah, that's very valid point, Khushbu. Okay, so individual pension plan, I see quite a lot of medical professionals, they go towards that simply because this is a retirement planning which provide a defined benefit. Defined benefit means that it will provide you a certain fixed amount as pension after the retirement for the rest of your life. It is derived based on a formula, and investment is designed to provide this benefit for the remainder of the life. It results into a higher contribution limit as compared to the RRSP. RRSP, as you all know, is about 18% of your earned income from prior year, but IPP tend to have a higher contribution limit. It's calculated by actuaries and the financial planner who specialize in the pension plans, and it can have, you could have a bigger part of retirement funds through this IPP. Any contribution to the tax IPP is tax deductible for the corporation. So you could defer the taxes. It's an expense that is claimed on the income of the corporation, so you're not paying any taxes, and it goes into your retirement plan. Of course, you'll pay taxes when you receive the pension after the retirement, but for now, there's no tax payable. IPP is it's a structured plan, so you have to have a plan administrator. You have to have a actuarial evaluation on an annual basis, so that the plan remains strong and able to provide you the pension at the time when you need it. So those are additional administrative costs. So the amount, your income must justify it. It's not good for everybody, but people who have higher income is a really good plan to have. And the IPP can have your vesting and lock-in rules as well. Generally speaking, you cannot touch those funds until you actually retire. And even then, you cannot have a lump sum withdrawal from the IPPs. Because it provides you annuity over remainder of the life. So it has to be on a periodic basis based on the formula at the time of setting up the plan. It is a very good tool to provide retirement income, and it provides you that peace of mind that at least, okay, this is the amount you could get when you retire. It really provides you a vision that by investing now, how much you could get at the time of retirement. But you need a specialist to do this plan, and have to have an administrator who will take care of the setup. And that's all from me. If you have any questions, I'll be happy to answer.
Thank you, Anil. This was very informative, and I know this is very centered around dental practices, but it often makes me think whether there is a relevance of some of these tax strategies or tax efficiency strategies for even regular people, because in the last maybe year or so, given the downturn and uncertain macroeconomic environment, there's so many people who are working as contract jobs. Like they're working with a company, but as a contractor, and they've set up their own sole proprietorships or some corporate structure through which they invoice, even while they're working with the standard top 5 banks.
Right.
And I'm wondering if all of these strategies will actually sometimes apply to them as well, especially if they're using a holding company, or wouldn't.
They do actually. Holding company is a concept which any business can use. It's not very specific to the dentist or medical professional. Holding company is designed to move away from the corporate operating company, because operating company normally is dealing with a lot of public. Let's say as a dentist, you deal with a lot of clients, a lot of patients who come in, and if anything goes wrong, somebody comes after you. You don't really want to have too much money in the professional corporation. Right, so it's a very good protection against any unwanted legal suit or liability that come your way for any reason. So holding company is a way that you can move money from the operating company into another entity, and you can invest from there, and investment opportunities are unlimited. It could be like buy properly, real estate, or any other thing to their liking, and it can be used by any business.
Okay. Yeah, and Adam, don't know. I know of a lot of people who just set up some corp. They have no idea how else to use it. And a lot of people who moved into the contract jobs have just set up some corp because they need to have a corp to invoice the company that they are working with, without realizing that they may have benefits to having a structure like that overall.
That's right.
Especially as a contractor, when there's uncertainty of income, it would be good to just know some of the benefits as well.
Yeah, and it's a very good point, Khushbu. I mean, as a contractor, because the income always may not be very, in the stream of income may not be very, very regular, right? I mean, you could have a bumper months, and then for a few months, maybe you are still working on a project. There's no inflow coming, but you're still putting out those expenses. You still have to live. You need money for your personal use as well. So this could work as an equalizer of income stream to you personally, So you can hold the money in the corporation till you actually need it, right? And as and when you need, you draw that salary for yourself. That way you can defer some taxes for a certain period.
Yes, because I know, for example, in like this is what was in my mind. Like it helps you kind of, I don't know, streamline your income rather than it being bumpy. Because I know I was talking to a lot of customers who are actually in contract roles or are small business corporations, and there was this random contract, I don't know, pause of some sort, end of year last year, which they had never experienced before, but a lot of government entities decided they will not pay you for 15 days. But they kept asking questions. So all of these people, contractors, actually ended up working the whole freaking time, but we're not getting paid. And
That's right.
that's just almost unfair, but that's how it was. And they were contractors. So the government, there's officially no work for 15 days of December, which is the holiday season, which is when people need most money.
That's right. That's right. So no, it's a very good point. Very good point. Okay. So Khushbu, any other questions?
No, I think that's it. But I think somewhere between the last session and this one, Anil, at least I have learned a lot, and maybe we will distill this into some of the at least high level points that people can refer to in the form of a blog. We will review it with you, and then we'll put it out there so that people are aware that there are advantages to this, while there are disadvantages to an uncertainty of income. And make the best of some of these policies.
Thank you, Khushbu. Thanks for the opportunity to present this, and have a wonderful day. If there's no other questions, we will call it a day.
Yes, thank you so much, Anil, and thank you for sharing your wisdom.
You're welcome. Have a good day.
All right, bye.
Bye, everybody.